Good afternoon, everyone. My name is Matt Gordillo, partner and financial advisor with Park Edge Advisors, and welcome to our September Market Insights. I'm joined by our partner and chief investment officer, Rich Lowry, and our portfolio analyst, Gavin Gowecki. So let's get right into it. And Gavin, why don't you give us a recap from last month's Market Insights?
Yeah, hey, Matt. So really what we like to start off with is look at stocks and bonds. Month over month, not a lot has changed in terms of we've had a broadly defensive view of markets for stocks and bonds. And what I mean by that is, we could look at the 12-month returns over the last year for stocks and notice that the quality factor, meaning companies with strong balance sheets, with a lot of cash on their balance sheet. We could look at Visa, we could look at Apple. Those types of companies have done well relative to the S&P, and then really well relative to the Russell, which a lot of the companies in the small cap index, don't have that cash on their balance sheet. So, that's kind of how that's unfolded. And then on the bond side of things, again, not much has changed in terms of the Fed keeping rates higher for longer on the short end of the yield curve, making treasury bills, 1 year in duration or less, the most attractive place still to be.
Very good. Thanks, Gavin. This morning, Rich, the August inflation report was released, and it's been an unusual year. It seems like bad news for the economy has been good news for the stock market, and a lot of that has to do with inflation. What's your take on the report this morning, and how is it going to affect us going forward?
Well, it had some good news and bad news, depending on how you look at it. The good news is that core inflation slowed. We're looking at 3-month annualized. So the month to month, if you look at that, is a little too noisy. The year over year doesn't properly reflect where we're heading. So we usually look at the 3-month annualized. Core slowed to 2.4, which is the slowest since March of 2021. So that was the good news. The bad news is headline reaccelerated to 3.9% on a 3-month annualized. So it was kind of a mixed bag. And I think we're at a point now where going forward, inflation is going to remain sticky. We're probably going to see some reacceleration. Oil prices are higher, food prices are higher. That's going to continue to feed in. But I don't think inflation is really going to be the story, going forward. I don't think the Fed funds rate is going to be the story going forward. I think it's going to be more about the Fed meeting next week. What do they say about their year-end economic projections for both 2023 and 2024? And what do they say about the balance sheet? They've had the balance sheet on autopilot, and you have had a negative inflection in liquidity. If you go back a couple of meetings, we thought liquidity would inflect negative after the debt ceiling was increased. That didn't quite happen, although the Treasury came to market, they issued T-bills, and all that really did was pull down the reverse repo facility at the Fed. But from the quarterly refunding announcement by the Treasury on 7/31, all assets are down. And basically they came out and said, we're going to increase the amount of debt issuance, and we're now going to issue longer duration bonds, and that directly reduces bank reserves. Since then, pretty much every stock market category is down, every bond market category is down. The only things that are up are oil, broad commodity index, US dollar index. So I think that is going to be the story, going forward, is what we see more on a liquidity front rather than either Fed funds or inflation front.
Okay, good. Thank you. Gavin, any additional comments related to the inflation report today?
I think Rich basically nailed everything. I agree with everything there. We talk about it, right, Rich, all the time. I would just reiterate higher for longer, and that inflation remains sticky, like Rich said. And just keep watching like we do every day. Next week right now is a 97% chance of a pause. That's the highest we've seen. And when we get that close to an FOMC meeting and you have a very high conviction number like that, you usually get that outcome. So that's what we're looking at into next Wednesday's meeting, most likely a pause.
Very good. Well, Rich, I know you are a fan of charts, and I bet you have a wonderful chart to share with us. I was curious if you had anything that you've been looking at or studying that might be telling, and as it relates to different phases of economic cycle that we're in, et cetera. So,
Well,
what do you
I
for
have 100 charts, but I'll only show one. If we look at where we are in the economic cycle, we've talked in the past that recessions come in two distinct phases. Phase one is the liquidity cycle downturn. That's where interest rates go up. That's where the Fed reduces its balance sheet. That's where bank reserves contract. It's where credit is restricted. That's phase one. That obviously was a story of last year. There always is a lag between phase one and phase two. During that lag, it always gets labeled as a soft landing. It happened that way in 73. It happened that way in 1980. It happened that way in 2000 and 2007. And all that is really the lag between when liquidity tightens and when that takes a bite out of the economy. So we've also reviewed, if you look at the cycle in terms of the acronym HOPE, HOPE, housing is always the first to go, and that is down pretty much on schedule. New orders are the next to go, and that is negative, almost right on schedule. Production is the next to go, and that's negative, almost right on schedule. And the E is employment. So we haven't had employment go yet. That is the one thing that it's always the last to go. And I want to pull up a chart which kind of captures where we are in the current cycle. All right, can you see this?
Yes.
So the black line is the current cycle, the blue line is previous cycles. So this has employment broken down into the leading employment categories. And as you can see, the leading employment categories are already negative and have been for several months, and that the direction is still pointed down. Here is the coincident employment. And when the Bureau of Economic Analysis, the National Bureau of Economic Analysis officially declares a recession, they do so based on coincident indicators, and they also do so with a lag. I mean, it's not uncommon for them to call a recession after the recession already ended. So we're not going to wait around, for them to declare a recession. But what we want to know is, when is the final peak of the market likely to happen? And this is pretty interesting in that this is following almost right on script. The pattern of employment, the fact that employment has actually increased, even while we've been calling for a recession all year long, is pretty much following the script. And you can see that there are maybe 4 months before this is expected to go negative. And that's typically where the recession is going to happen. Now, the stock market doesn't wait. Sometimes it's going to front run that. Sometimes the peak of the market has been up to 1 month after employment goes negative. But I call that the most important chart in that is the last holdout. We're not going to get the full effect of the recession until employment goes negative. And then once that train leaves the station, so to speak, that's not a noisy data series. Once that breaks out, it tends to have some sustaining power. So that's what we're going to be watching closely. And if you look at that, it would set a recession time frame for sometime around year end. And so as it relates to phase 2 of this recession, the credit cycle downturn, that's highly contingent on employment going negative. And that would put a market peak somewhere between, say October to November, up to January. So, there is room to get some kind of market bounce. It's becoming harder to see because, as I mentioned previously, liquidity now is back to being negative. And then as you look out at catalysts, you have student loan payments that are going to kick back in. That's been a significant contributor to spending over the last couple of years. You have another debt ceiling showdown. It seems like we just got done talking about a debt ceiling showdown.
Right.
Now you have talk of the so-called motion to vacate, which allows a single member of the House to call for a new vote on the Speaker. So the Speaker is going to be very constrained in terms of how he deals with any debt ceiling negotiations. So there's a number of catalysts between now and then that, to me, it doesn't seem, even if we felt confident that the market peak, is going to be, let's say November. There are too many catalysts between now and then to do anything other than remain defensive. And I think the real opportunity is going to be on the other side of the recession.
That's great. That's certainly a compelling chart and some good information there, Rich. And, appreciate you guys' insight this week. And, we've got a Fed meeting next week. And, I kind of feel like we're being in the swing of football season. I kind of sound like a coach. We have to focus on what we can control. And, I think that for investors and our clients, that's being patient as investors and tuning out the noise. And really, with all this uncertainty that still has to play out, the possible recession and September historically being the worst month performance-wise in the market, I think it's just important that we focus on, if you have any questions, to contact us about your portfolio and how it works together with your plan to accomplish your goals. And just, as a team here at Park Edge, I think we can really add a lot of value to help clients weather through these uncertain times, and certainly have a lot of good information, and we're here when they need it. So appreciate your guys' time this month, and we'll have a great update again next month.
Well said, Matt.
Thanks,
All right,
Matt.
take care, guys.
Thank you.
Take care.